Welcome to our podcast on crypto tax strategies, where we dive into methods like FIFO, HIFO, Spec ID, and even pooling systems to help you navigate your taxable gains.
Sounds intriguing. So let's start with the basics. Why does crypto taxation even matter?
Well, whenever you sell, trade, or use crypto to purchase goods, you're triggering a taxable event. Most countries treat crypto like property, meaning capital gains tax comes into play.
Yeah, exactly. And this is why understanding these methods, FIFO, HIFO, and Spec ID, is crucial for determining how much tax you owe, right?
Right, absolutely. Each method calculates your cost basis differently, which ultimately affects your taxable gains.
I get it. So let's break down FIFO first. Can you explain its approach?
Sure. FIFO stands for first in, first out. Basically, it assumes the first coins purchased are the ones sold first. For example, if you bought ETH at different times and prices, FIFO means selling your earliest purchase, which in a rising market might result in higher gains.
Yep, that makes sense. And that simplicity is why a lot of traders and tax authorities like using FIFO, even though it might not always be the most tax efficient, right?
Exactly. It's well recognized, but in a rising market, plus the fact that early buys are usually cheaper, it could increase your tax liability significantly.
True. Now, what about HIFO? That method always seemed like a smarter strategy if you want to minimize gains.
HIFO stands for highest in, first out, and it works by selling your highest cost coins first. By doing this, you can lower your gains because you're offsetting high cost basis. For instance, if you bought Bitcoin at $10,000, $15,000, and $25,000, HIFO would pick the
That strategy really
$25,000
targets the
one when
tax
selling,
liability head on.
thereby lessening the gain.
But HIFO sounds kind of complicated. Don't you need very detailed records to use it correctly?
You do. It requires meticulous tracking since you need to know exactly which coins are which, including their purchase prices.
Exactly. And then there's specific identification or Spec ID. How does that compare?
Spec ID lets you choose exactly which asset you're selling based on your detailed purchase records. For instance, if you have several BTC bought at different prices, you decide which one to sell to optimize your gains. It's flexible, but demands careful record keeping to justify your coin selection.
That sounds like it has all the advantages of tailoring your taxes. One thing that puzzles me, isn't there some argument that switching methods mid-year might be beneficial, or is that generally not allowed?
That's a great point. Most jurisdictions require you to stick with one method for the entire tax year. Switching mid-year isn't allowed unless, you get special approval. Stick with what you choose early on to stay
consistency
compliant.
really is key here. Speaking of compliance, record keeping seems to be a recurring theme. Can you talk about best practices for that?
Definitely. Whether you're using FIFO, HIFO, or Spec ID, you've got to document every transaction thoroughly. This means dates, times, amounts, costs, and fees. Some even use dedicated crypto tax software, like Coinly, for example, to automatically track these details.
That level of precision helps avoid audit nightmares. And what about multi-exchange or multi-wallet holders? I mean, it sounds like it can get really messy if you're not consolidating your data.
Exactly. It's critical to consolidate your accounts and gather all your purchase and sale data in one place. Missing a transaction could mean a penalty or audit down the road.
Yeah, good point. Now, I know in the UK they use something different with pooling, aren't they?
Yes, the UK uses a pooling system where all the same type of crypto, say BTC, is grouped together. The average cost is then used as the cost basis. And there are rules like the same-day and 30-day rules that ensure you're not manipulating gains just by quickly buying and selling.
So that system really streamlines reporting in some ways. But doesn't the pooling method limit the flexibility compared to, say, Spec ID?
It does. Pooling provides consistency, which is great for authorities, but it doesn't let you strategically pick assets to sell. That's why jurisdictions like the US offer more flexibility, allowing FIFO, HIFO,
Yep, that
or
trade-off
Spec
between
ID.
consistency and flexibility is definitely something to consider. And then there's LIFO. It sounds like a logical counterpart to FIFO, but I heard it's rarely allowed for crypto taxes. Why is that?
Correct. LIFO means you'd sell your most recent purchases first. Though it might help reduce gains in a bull market, it's generally not accepted because it complicates tracking and can lead to strategic tax avoidance. Most tax authorities, particularly in crypto, discourage LIFO in favor of simpler methods.
I see how that could get messy. It seems like every method has its trade-offs. Simplicity versus flexibility. Ease of tracking versus optimal tax savings.
Exactly. And the right choice really depends on your trading activity and the specific tax laws in your country. For instance, a casual investor might find FIFO perfectly sufficient, whereas a high-frequency trader might lean towards Spec ID or HIFO to minimize gains.
Yes, it really comes down to your individual strategy and record-keeping capacity. So, let's say a trader in the US with a high volume of transactions would need to be extremely diligent in their documentation to take advantage of HIFO or Spec ID.
Yes, that's absolutely right. High frequency means high stakes when it comes to documentation. Those detailed records help to support your cost basis method in the event of an audit and prevent misreporting
Kind of like having
and
a really
unexpected
detailed
tax
diary of every
liabilities.
trade. And what about advice when it comes to consulting experts? Isn't that stressed a lot?
Definitely. Given the complexity and variations across jurisdictions, like the differences between the US, UK, Australia, and others, consulting a tax professional is highly recommended. They can help tailor the strategy to your personal trading habits and ensure compliance with local regulations.
Right, and that could really save you from costly mistakes. Now, there's also a notion that these strategies can actually optimize long-term financial success by keeping tax liabilities low. Do you think that's a bit optimistic?
Not at all. While these methods don't change your trading gains, they can significantly impact how much tax you pay. Optimizing your strategy using methods like HIFO to minimize taxable gains can mean keeping more money in your pocket over time. However, one must be cautious and always report accurately to avoid legal issues.
Balancing risk and reward in every sense. There's also an interesting statistic regarding Norway, isn't there? Something about 88% of crypto holders not reporting their gains.
Yep. In Norway, a study showed approximately 88% of crypto holders failed to report their assets, leading to significant tax losses, estimated between $50 million and $272 million. This really highlights the importance of proper tax reporting and record keeping.
Wow, that's a staggering figure. So it sounds like regardless of which method you choose, accurate record keeping is the foundation for anything else.
Absolutely. And it's not just about avoiding penalties. Good records allow you to plan ahead, adjust your strategy if needed within the legality of the system, and ultimately make smarter decisions as the market evolves.
Clear records are a trader's best friend. Before we wrap up, can you share any parting thoughts on how to pick the right method for someone's situation?
Sure. First, understand your tax obligations and local rules, whether you have the flexibility in your jurisdiction. Then, evaluate your trading activity. If you're a casual investor, FIFO might suffice. If you're actively trading, HIFO or Spec ID could be beneficial, provided you can track everything meticulously. And lastly, consult a tax professional. It's all about alignment with your financial goals and risk appetite.
This has been super insightful. It's like unraveling a mystery where every piece of data matters, right?
Exactly. Each method provides, it's like a different lens to view your gains and losses. Staying informed and organized is key to effective crypto tax strategy.
Thanks for breaking that down so clearly. This conversation definitely makes the complex world of crypto taxes feel a bit more accessible.
Glad to hear it. Remember, whether you're using FIFO, HIFO, Spec ID, or even the pooling system, always stay on top of your transactions and local regulations. Happy trading and happy reporting.